Hi, everyone. Welcome. Hello, everybody. Welcome to the live stream today. As always, I'm looking forward to what we have to talk about. Is there's a lot going on in the market, obviously, and a lot of things to talk about as we get things rolling. Excited for those of you that are here. Hopefully, we'll get a few more coming in as we get things rolling. And if you're watching after the fact, I do like to make this live stream available for everybody after the fact through the Discord server as well. So either way that however you prefer to take this, I'm grateful for you and excited to be able to talk about what's going on in the markets today. Just really quickly, if you are new to Rebel Income, just a couple of housekeeping items, and then we will dive straight in. Talking about the Discord server, there's a few specific channels that you're going to want to pay attention to. I take time to make sure to put in to add content every day to the Discord server for you. And so there's a few different areas that you want to really pay a lot of attention to. Under the Rebel Income System category on the Discord server, there's a few specific channels. If you are brand new, you don't know anything about Rebel Income, go ahead and start with the Getting Started area. Also, Rebel Income Welcome will be useful for you as well. There are videos there that outline a lot of detail about how Rebel Income, how the investing system works, and will get help to give you a good start. I publish weekly trading alerts on Tuesdays in the Trade Alerts channel. This is Rebel Income is really all about income generation. And so the trades that you're going to see me publish are going to focus on put selling, covered calls, and bull put spreads. And so each Tuesday, I will publish the trade on a new stock for the week based on what we are seeing in the market for those specific stocks. This week's trade was on Skyworks Solutions, and so you'll see me post one possible setup for each type of strategy: put, sell, covered call, as well as a bull put spread. Monday, Wednesdays, and Fridays is when I like to try to publish just generalized reports about stocks in my watch list, stocks that have come across my desk, and I take those through. I look at those through the lens of the Rebel Income System. I use all of the different criteria that I apply to every stock that I use for the Rebel Income System and try to evaluate if, number one, the fundamentals hold up, number two, is it a good value, and number three, does that translate into the kind of opportunity that we would want to try to think about and take advantage of. Sometimes that research translates uh, into the next week's trade, and this week's trade on Skyworks is a really good example. Here's where I published a report on Skyworks last week, and that translated into the trade that I used for this Tuesday. Live webinar is where you are going to see me post a link to this live stream. I try to make sure to do that each Thursday, the day before the live stream, so that you have access to it. I will also post the link in the recordings channel after the fact, if you prefer to take a look at this content. You weren't able to do it during the live stream, so you want to do it after the fact. Thursdays, you will also see me post an article that tends to be a little bit more broad-based, talking about Rebel Income System and some of the different elements that I've built into the system, why they work the way that they do, some of the details about the points of analysis that I focus on. Excuse me. To try to help build our community and give you an opportunity to interact not only with me but also with other members of the community. We also have an open discussion channel. You can message me here if you like. I pay attention to this throughout the course of the day and will try to respond as soon as I can. I also respond to direct messages. This is also an area where if you want to try to engage with other members of the community, I'd certainly like to encourage it. As a thank you for being part of Rebel Income, if you've subscribed to my channel on YouTube, you know that I post videos there a couple of times a week. And one of the things that I do with this early access channel is to make those videos available to you first. Typically, the day before I publish them, For everybody else, I'm going to give you access to them. That's just a way to say thank you for being part of Rebel Income. Okay, that's the Discord server. Let's go ahead and dive in. We are looking at the second Friday of December. Excuse me. Wow. I guess I'm already trying to get into 2025. I almost said February. We are in the second week of December, and it is Friday. That means that there are options that are expiring today. I don't have any currently open positions that are scheduled for expiry, but there are some coming up next week on the 20th that we'll spend some time looking at. I have a number of those on deck. If you have some stocks that you're interested in taking a look at as well, feel free to put those in the chat. Also, if you just have comments or questions about some of the things that we're going to be talking about here in the next several minutes, then feel free to use that chat as well. I'll be watching that, looking for those comments and looking for opportunities to fold those comments into the live stream. All right, let's go ahead and get things started. What we have on the screen now is my track record. This is where I keep my log of my weekly trades. And excuse me. Let's start with the put sale that I placed on the 20th of November, a little before Thanksgiving, on BorgWarner, stock symbol BWA, selling the 32.50 strike price. This was a 1 month trade, bringing in about 2.3%. So let's take a look and see where BorgWarner is as of now. All right, I sold the 32.50 and strike price, and we're sitting at about 34.12. So this looks like it's in a pretty good spot as far as even with a week to expiration, looks like it's in a pretty good position to expire, possibly worthless. We have the 200-day moving average that is started to slope upward here, and as we can see over the last couple of weeks, has really provided some solid support for the stock as it's come down to that level a couple of times, but never really managed to stay below it for any extended period of time. And that's even as the top end of the stock's trading range has also been capped at a little above $35. That support has been useful for the stock, especially relative to the price that I sold. So again, we're in a good position on this trade, 32.50, bringing in 75 cents. Let's take a look. My normal method as always is to wait until expiration and see what the stock is doing. And I don't avoid stock assignments if the stock is below 32.50 at expiration and I haven't already been assigned. I will take the assignment because these are companies that I like to follow. They have good fundamentals, nice value proposition, useful dividends, and that makes them more than useful enough for my purposes. But sometimes there's also opportunities to take a different approach. And I don't shy away from talking about these, even if they're different from the method that I do, because I want you to be able to think about some of the different ways that you may be able to look at and think about the same trades that I'm placing in a different light and still have them be very functional for you. Okay, here's the December 20th expiration. This is the 32.50 strike price, and we can see the bid is 5 cents. Asking price is 15 cents. Have a pretty healthy distance between the two of them here, considering relatively where the stock's price has gone. Little bit of volume, some good open interest on this. Six contracts traded and about 407 contracts in open interest. I like to see at least 100 contracts in open interest just to try to ensure there's plenty of liquidity. Excuse me, I apologize. Didn't have an opportunity to mute my audio before I did that. Okay. So what that means then is that if you wanted to buy this contract back right now, you could do it at 15 cents. You could also try to go somewhere in between, maybe put in a buy to close at 10 cents. if you wanted to and wait for the market to come to you. There's a fair chance you would get that, considering that the last price was at 12 cents. Again, you might have to wait for a little bit. This is still a week to expiration. And so it's also one that may take, it's not not worth ignoring the possibility of just letting it play out for a little bit and letting time decay continue to play its role. Now, the risk of that, of course, even with just a week to expiration, is that the stock could still drop down below 32.50. I see that as not a really high probability thing right now, just because of the way that the 200-day moving average has been providing support. And in reality, 32.50 is all the way down here where my ugly blue line is. And that means that the stock would not only have to break support at about almost $34 per share, where the 200-day moving average is at, but also some pretty solid support here at 33 as well. So I'd have to break a couple of levels of support just to get down to the price that I sold on my put option. So this one looks like it is in a pretty good position. But if you wanted to take a little bit more active approach than what I do, which is just to wait and let it play out, there is an opportunity to think about whether or not to buy this back. And if you didn't want to wait for the market to come to you, you'd have, I brought in 75 cents on this. If you just paid the 15-cent asking price, obviously you'd end up with a net credit of 60 cents on this. And that's not terrible on a 1 month trade on an option with a 32.50 strike price. Sorry. This is where I need to stop talking at the same time that I type sometimes. There we go. You still end up with a 1.84% result. And this would shorten that 1 month trade down to 1 week. Jay, you made it. And so, this is one of those that is something that it's worth thinking about. Is this something that would be an advantage for you? I brought in 2.3% for 1 month, and I like that, and I'm going to let that play out. And if it expires, I'm going to keep my 2.31%. If you decided you wanted to try to go ahead and close this out early, what is the advantage? Number one, you close out the possible obligation of being assigned if the stock does break down in the next 7 days, where I may be on the hook for that. That would you would eliminate that possibility in your case. Not a recommendation to buy or sell or to say exactly what you should do. I'm just trying to outline what some of the different possibilities are. It also gives you an opportunity to shorten the duration of the trade. When you work with shorter durations, even a 1 week difference can really make a difference in terms of your ability to leverage trading frequency. This is a phrase I like to use a lot because we do try to emphasize short-term trading strategy. We're working with very short-term contracts, typically of no longer than a month at a time. That means that we're trying to put the element of time decay that is natural to all options in our favor as much as possible. When you work with shorter periods of time, you're doing that even more. When you compare 1 month to 3 weeks to 2 weeks to 1 week, you tend to see the way that time decay accelerates even more significantly than what you will see for options over an extended period of time. But just to kind of illustrate what we mean here, well, that's interesting. All I'm getting here are December and January. I'm not getting any additional expirations here. So I can't illustrate this with Borg Warner in the same way. But just to show you the same contract, 32.50 here is their current bid, 50 cents, 55 cents. Here's 35 cent at the $35 strike price, $1.55 on the bid, $1.65 on the ask. Go back to 7 days, and you see here $1.10, $1.25 at 35, 5 cents, 15 cents. That's literally just the difference of 30 days of time, roughly 28 days of time in these cases. And so that's the impact that these shorter term periods have in your ability to place more trades. That's trading frequency. So if you were to do this, if you were to buy this back 1.84%, if you could reproduce that same 1.84%, excuse me, every 23 days. This is a 30-day trade. There's still 7 days to expiration. So let's go ahead and keep in mind 1.84% and divide 365 by 23. That means you're placing not quite 16, you're going to place 15 trades per year. So 1.84% times 15 would give you an annualized result of 27.6% per year. That's, again, this is theoretical. This is your actual results are going to vary from trade to trade, but it does illustrate the benefit that one of the advantages that you can start to get from placing more trades covering less periods of time. By comparison, the 2.31% that I have made so far, and if this trade expires worthless next week, I will have realized over 30 days, that means I'm going to basically make 12 trades, right? One a month. About 27.72. So relatively comparable, not a little bit lower, not a ton. Not the best example. I've just kind of shot myself in the foot here with that. But sometimes you'll see significant enough differences, even just over a 1 week period of time, to flip the result. So, okay. That's Borg-Warner. Jay, you said you made it. Did you mean made it into today's live stream, or that you made the trade with Borg-Warner? If any of you have been in this stock as well, you maybe have different numbers than I do. Feel free to share them into the live stream. Well, as always, happy to have everybody here that is here. So thank you. He's also in Borg-Warner. Okay. Well, again, if I brought in 75 cents on this. If you want to throw out some numbers for comparison, that's fun. So totally up to you. All right. Next on deck, let's go. I'm just going to kind of go up my list in order. So let's go ahead and talk about FMC. This is a stock in the materials sector that I've been following for the last few months. Placed a couple of trades on and was assigned the stock in mid-November at $60 per share. Had an opportunity to sell a 62.50 covered call on this, bring in about 1.5% for a 3-week trade with a little bit of capital gain potentially built out if I get called out of the stock. So let's see where FMC is at right now. All right, all of that really sounded great before I said it, before I pulled up the stock when I said it, but we can see the stock is really starting to accelerate a short-term downward trend here just in the last 3 days, picking up bearish momentum, breaking through support here at around 54 today, pushing down to a little bit above $53. So this is picking up some bearish momentum here. That's not great to see. My purchase price is up here at around $60, which was looking pretty good, especially when I sold the covered call. So unless we see a pretty major rebound in the next week, it looks like I'm still going to hold on to those shares. This breakdown, though, this little bit of this pickup in bearish momentum here is worth talking about a little bit. Does this look like a concern? What if some of you are also in FMC if you're seeing this happen, what does your decision making process stop? Or excuse me, does your decision making process change? I should say, it doesn't stop. You still have to make decisions, but does it change? Does your opinion of the stock shift? Okay, Jay started working with lower covered calls, so you went to 60. All right, and given the direction of momentum right now, right, where we're starting to see it kind of bend over here, possibly this may be a little bit of sorry, the word is escaping me, but it's kind of not only picking up a lot of bearish momentum, but just the last 3 days we've seen volatility pick up quite a bit here. And as it's breaking through that most recent support level, we start to beg the question of where is it going to find support next? Jay, still good premiums, yes. And if I go all the way back to February, I see this pivot low here. I'm going to go ahead and call this 51. Looks like the stock has got a couple of dollars of downside yet. Still another week, that is true. Literally speaking, support could be anywhere between the stock's current price and where I expect it may occur at 51. So we could see it rebound and start to go back up again. That would be pretty nice, right? But in the meantime, it is interesting to see how it is starting to pick up. Now, I don't work with stop losses on the stocks that I've been assigned. But cases like this do make a practical discussion about the use of stop losses reasonable. And so, you know, begs the question of how, if you do take assignments on some of these stocks, should you use a stop loss? How close should your stop loss be? I like to go without working. I prefer not to use a stop loss, not because I'm immune or blind to the possible downside of stocks continuing to drop significantly below the strike prices where I'm assigned, but simply because when I take these assignments, I treat these put sales as gateways to stock ownership in stocks that I really like. Yeah, well, and thank you, Barry. I appreciate what you're saying. It seems to be the trend. Wrote a CVS covered call at 61 on 11/25 to expire today, and it's also heading down. And this is actually something that I did want to talk about, so we might as well do it now. CVS is another stock that I was assigned earlier, and at 64. So I'm in on this stock all the way up here. Looked pretty good as it was rebounding here, and then it collapsed, started to rebound a little bit, and then in the last couple of weeks, we've seen it drop back and really accelerate that bearish momentum all over again. So these are situations that we should be thinking about as put sellers if we're actively taking taking assignments from these put sales. You have to understand that sometimes these are going to happen and decide what you're going to do about them. As I mentioned, I don't use stop losses, not because I'm blind to these movements, but because these are stocks, these are companies that I like. I've decided that I'm willing to work with these over a long period of time potentially, and I'm okay holding it. The dividends that they pay are going to be, I've decided they're functional enough that I'm okay just sitting in the stock and taking in that passive income while I wait for the stock to recover. So near term, for me anyway, near term momentum in the stock for or against is really kind of a secondary concern or even a tertiary concern as to what I think the overall long-term opportunity is. And for CVS, I think that there's a lot of uncertainty that has been coming up in the news lately for CVS about its place in the pharmacy benefits as a pharmacy benefits manager. There's rumors about some potential legislation coming from the new administration in 2025 that may force them to unravel their PBM business. So we'll see what that looks like. That is one of the things that is pressuring prices right now. Legislation, federal rule changes, those kinds of things are elements that investors and even companies really have little control over. And so sometimes those represent an extra risk. Are those the kinds of things that make you change what your perspective may be? If so, then this is where maybe a discussion about where to put a stop loss may be practical. For a lot of people who that I know that like to buy stocks, even with a long-term perspective, they will still try to limit their overall downside in these stocks by using a stop loss anywhere from 15 to 20% away from what their purchase price was. So if I'm talking about CVS and I'm in at $64, that means that if I want to use a stop loss at 20%, I'd multiply that by 80, and that would have been at 51.20, which means that the stock would have broken that stop loss point yesterday, and I'd be out of the stock now. The way that momentum is looking in the near term, that may not be a bad choice. Again, I'm okay holding on to this stock, even with this momentum doing what it is, because I believe the value proposition is still much higher. And so we will see what happens with this. I'm willing to let this play out. Not everybody's going to, and if you're not using a stop loss, but some of the news that's out there is something that you think is enough of a risk to change your perspective about the long-term opportunity, maybe limiting your loss by trying to get out now makes sense. Barry says, I was assigned at 59 in November. So you got in a lower price than I did, Barry. And so, you're not in as much pain as I am. But still, 59 versus 49, that's a $10 difference, right? And so if you're applying the same stop loss mentality, then maybe it's around 47. Again, not a recommendation on what you exactly should do here, but just trying to identify what some other options are, some other possibilities to think about, and some different ways to approach the trades that we're placing and the way that you want to think about and manage risk. As always, my number one rule when it comes to managing downside, and I know you've heard me beat this drum many, many times before, it's always going to come down to position sizing. CVS, I'm really not as concerned about the downside as much because I only sold one contract in this. So I hold 100 shares at $6,400. Even if I have to sit in it for an extended period of time, it's a relatively small amount of my account, so it's not as painful. Excuse me, going back to FMC. Again, I was assigned this one at 60. So if I were going to use a stop loss here, that would have been at 75. What? Wait a minute. That doesn't sound right. Times 0.8. There we go. It would be at 48. Sorry, I don't know what happened with that. Which the stock has not approached yet. We're still several dollars away from that. If you wanted to use a tighter stop loss, you could. Barry brought in $2.14 for the put and another $1 for the call. So being in at 59 and having generated $3.14 in premiums so far, that's not to say anything, about dividends on CVS, right? That may come in the meantime. But at 59, 5.3%, not bad, Barry. Oops, I did not want to eliminate my calculator. There we go. So for Barry, that's worth a tick mark. Jay, I'm gonna kind of do the same thing with CVS that you talked about as well. So, let this thing play out a little bit. And I do believe the long-term opportunity continues to be better than what current news looks like, than what the stock's current state of momentum looks like. Although it is, to be clear, this ain't fun. Looking at that and seeing that is something you have to think about. That is a little bit of a punch to the gut. And as a put seller, these are the kinds of things that you do need to think about. Okay, let's go back to some of our trades we have on deck. From the beginning of December, I have a put sale on Huntsman at 20 that I placed. Now, full disclosure, I own Huntsman at a much higher price than 20, and so this was an opportunity for me not only to place a functional trade with another stock that I like, but also to hopefully reduce my cost basis a little bit in this. And we can see the stock is also kind of doing the same thing as FMC right now, picking up bearish momentum, sitting below 19 at the moment. Have a little gap down here that seems to coincide with the dividend on this one. So looks like I will be assigned here my additional shares. My overall cost will go down a little bit, but this is the really the bottom end of a pretty extended downward trend for Huntsman. Barry, I like this. This is interesting. From a personal standpoint, I may just go ahead and set up dividend reinvestment for the stocks that are so far away from the entry price. And that's a great point. Those dividends come in, they are now passive income. You can decide what you want to do with those dividends. You may decide to use them to help with your living expenses if that's not something you need. If what we're doing with put selling and income generation is part of a longer term wealth creation strategy, dividend reinvestment is kind of smart because you're able to buy additional shares with the money that you're bringing in from those dividends. It may not be a ton, right? If we're talking about, let's go back to CVS for example. Again, I own 100 shares in this. Here's a dividend from October, 66 and a half cents. That meant that I got a credit of $66.50 on my 100 shares. I could have bought one share with a dividend reinvestment program. That doesn't sound like a lot, but it's still one more share. And again, over time, that does add up. So it's not the worst idea. It does lower your net cost basis a little bit as the longer that those dividend reinvestments happen, and you are able to acquire more shares. So not terrible, not the worst idea. Okay, so Huntsman is again picking up bearish momentum. Looks like I'm going to be taking that assignment. And this is one where, if this is enough of a drop from 20, $1 on a $20 stock, remember that's 5%. So that's not 20%, but still sizable in a very, very short period of time. And so if you wanted to try to minimize the loss or the potential additional downside risk from being assigned shares at 20, you may think about buying the option back right now. Here we go. Let's compare my numbers here. I brought in 60 cents on the put sell for Huntsman. And if I wanted to buy that back, I'd have to pay $1.25. So I'd eat a loss of about 65 cents per share on this. I sold, I'm going to say 2 contracts. Yeah, I sold 2 contracts on this. So that would mean a total loss of $130. if you decided to buy that back, eliminate the possibility of that additional assignment and thus limiting the loss as well. So that's something to think about, especially if you think that that downside risk could extend even further. Boy, right now it looks like we're moving from one poor story to the next, right? Take a look at LRCX. This is another one, another covered call. I was assigned this stock at $80, and so this covered call is also an opportunity to build in a little bit of capital gain if I get called out, bringing in a little over 2% in premium on the trade. It wasn't. It was about $78, a couple of dollars below the strike price that I had sold at the time. And let's go ahead and switch over here to this chart, and we can see it really been really choppy for the last couple of weeks. Picked up a lot of momentum here in October to fall down to around 72, bottomed around 69, and it's just really been choppy for the last couple of weeks. Get some separation on these candles. There we go. So it certainly doesn't look like I'm going to get called out on this unless it picks up a lot of momentum next week. Again, still a week to expiration, but the trends are really starting to condense. And by condense, I mean here's resistance, right? Here is support. So what we're starting to see here is, and if we wanted to follow this little upward trend as well, either way, we're looking at kind of a pennant formation, which is kind of interesting. That could be an early sign of a bullish reversal, which would be really nice to see. But we don't know how long it's going to take for that to measure itself out. The longer this consolidation range tends to kind of tighten, kind of narrow, the more likely that reversal becomes. It's like I often use the analogy of a coil. The more you tighten it, the more pressure you put on it, the more tension there is, the more likely it is to spring back with a lot of energy in the opposite direction. And so, with a bearish overall long-term trend, the longer this this tightening, this narrowing occurs, the more likely it is to spring back on the upside. So we'll see where this goes. But again, as with all the other stocks that I've been following, we'll see. I'm going to let it play out, and if I do, if the covered call does expire worthless, that's okay. Lam Research is a good company. I've followed this in my watch list for some time, and I like having it in my trading rotation. It's a good addition to my overall portfolio, even with some of the things that are going on in tech right now. Very awesome. 81 covered call on that one for 1,325, and Jay just rolled that one. Awesome. So we got the entire everybody who is here so far, at least, is in on Lam Research as well. It has been it's watching it really accelerate bearish momentum from the prices that we got in on it with the original put sale in October. That was pretty dramatic, right? But it's been interesting to see the way that it's stabilized and starting to form its own new consolidation range. Okay. Nice. Jay bought back for 2 cents and sold for 56. You know, that's you're picking up you're picking up the pennies that everybody else in the market is ignoring. That's the great thing that I love about covered calls, and even with put sales, is that you're doing that on a 1 week basis. Come on. That's not just pretty good, Jay. That's really good. I'm going to go ahead and assume, you can correct me, Jay, if you want. But I'm going to go ahead and assume an $80 strike price having been assigned. Yeah. Let's see. Yeah, at 80. So 56 cents. Good heavens. There we go. Wait. 0.56 divided by, there we go. 80. So you brought in 0.7%, right? 0.07%. Doesn't sound awesome. It's less than 1%. But when you think about what you just said, you're doing this every week. If you're doing this every single week, you're doing can reproduce that for 52 weeks. Hello to 36.5% for the entire year. This is why it amazes me that people pass up opportunities with covered calls, with put sales, because these are dollars that are just waiting to be picked up. They're right there for anybody to take advantage of. So that is an awesome result. And Jay, just like with Barry, there you go. I love it. Brought in $4, not including this week's roll. 5% just since October, right? That's awesome. That is a fantastic result overall in a stock. Let's not forget, in a stock that is down, that is below $80 right now. It's approaching 76, which is nice, but still brought in 5% on a stock that is down or not moving. Thank you. That's exactly right. This is why income generation is awesome. It helps to, in literal terms, you brought in $4 and the stock is practically right around your cost basis. Gee, how much stress does that alleviate in terms of thinking about the stock in practical terms as it's following the movement that it's doing? This is why the dividends are so useful. It's why covered calls are so useful. It's why all of the elements that we're working with in Rebel Income is so useful. It doesn't. You're not always going to have a situation like Jay where the stock is down at his cost basis, which creates what he says is no stress. I have lots of stocks that are still very well below what my net cost basis is. Huntsman is one of them. Even after I take that assignment, it's still going to be a little bit below my new net cost basis. But having that lowered also reduces the amount of stress. And when you reduce that stress, whether you eliminate it altogether or you simply minimize it a little bit, it becomes easier to think in objective terms and stop and to manage the emotions of the moment. Barry, I brought in a little over $3, but been writing longer calls for more capital gains, and nothing wrong with that. Again, whatever whatever floats your boat, I guess is the phrase, right? But whatever is the method that makes the most sense to you, Barry, you're awesome, man. You're at 77 net cost basis, and Jay is at 76. You know, these are all fantastic results. These are great examples of why I think Rebel Income and what we're trying to do with income generation is so effective. Okay, let's go ahead and check in on this week's put sell. Skyworks, I sold the 87.50 strike price, brought in 1.31%, which is below the amount I try to usually get on my trades, but again, 1.31% for 9 days. I figured that was okay. If I can follow Jay's model here, I think I'm doing all right with 1.3% over 9 days. So let's take a look and see where Skyworks is. Sitting up at $90. Yeah, I'm doing all right. 87.50 is my strike price. This expires next week. Is approaching resistance here at the 50-day moving average, and we've got some pivot activity around here as well. So we may not be able to rally a whole lot more, but it's also got this nice little positive short-term upward trend since late November that should help to provide some support as well. So maybe it just starts to consolidate a little bit here, and that's okay too. Barry, I keep getting burned on writing calls at the entry price and then it taking off. Now, you've seen I've had that happen on multiple occasions as well with some of my recent covered calls, right? So Barry, I'm right there in that boat with you. That is one of the reasons, and what he means for those of you who may not be aware. A lot of times you will see me write a covered call. Let's pull one up here. Here's Delta. I was assigned this stock a little bit before the pandemic started, and watched it drop quite a bit, and it took until November of this year to recover enough to make a new covered call opportunity a practical reality. I was called out at 58, which was the price that I was assigned at. Was assigned at 58, sat in it for 4 years, and got called out of that. I sold a covered call at $1.30, brought in 2.24% for that at the time. Now, in the meantime, Delta, they suspended their dividends for a little while. They reinstated them. Had a couple of opportunities in the early stages of the pandemic to do a couple of covered calls. So my net cost basis was lower than 58. But if we just think about where I bought, where I sold, yeah, I did get called out at the same price that I was assigned. When you sell a covered call, you have to go in with that tacit understanding that you're putting an absolute cap on what the total upside in the stock is going to be. And you have to decide if that's something that you're going to be okay with. I decided I was okay with that because I had been in the stock for a while. I liked the idea of being able to unwind the capital from that trade and have that come back into my account and be able to redeploy it in other ways. I had the same thing happen with MGA in October with BorgWarner. So here's another one with Conagra. Here's CVS. Here's Zion. So yeah, it's happened several times this year for me, and every time I just accept that that's going to be the case, and that's okay. If you want to do what Barry is doing, sell a little bit more time so that you can bake in the possibility or the potential for some additional capital gains, that's okay too. Whatever your preference is, what makes the most sense to you. So you'll see me offer up the trades that I'm planning to place, not because I expect you to be a robot and place the trades the exact same way, but because I want you to think about what you might do. And you might decide to do it the same way that I do. But if you do, I hope it's for your own reasons, not just because, well, I'm trying to do what Thomas does. But because that approach makes sense to you. If not, try to find some other ways, some other wrinkles that you think would make more sense as well. So, all right. Got a little bit of time left. Covered all of the stocks that I was planning to talk about. So I want to go ahead and open this up to you. Barry or Jay, feel free if you have a something that you've been following that you'd like to take a look at in the live stream that we can compare as a group, and let everybody else who's going to be viewing this after the fact, let them see it as well. Let's do it. Barry, still an MGA at 45. All right. This one is breaking down a little bit. This chart is a little bit busy. Let's go back to the other one. Jay got nothing this week. Okay, that's fine. Here's MGA. By the way, I actually like the way that this has been coming down over the last week or so. Their value proposition is really, really nice. And the only reason I haven't put on a new trade in MGA for this latest round of trades that I've got is mostly because I'm already in on Borg Warner. I like both companies a lot, and I'm not opposed to holding them both at the same time, but it tends to work a little bit better when I do one or the other. So that's expiring next week. At this point, it looks like it is going to expire unless the stock rebounds and moves back above where it was as recently as just Tuesday, right? So we'll see. Here's Gap. He says he's got another call that expires today at 27. What price did you get in on Gap at, by the way, Gary? Just for the for sake of my own disclaimers, I haven't done any analysis on Gap in a while, so I can't speak to its current fundamentals or its value proposition. So no recommendation to buy or sell here. This is for illustration and educational purposes, but it's looks like it's been a functional trade so far. This is one where we do get some weekly options, so we can use this as a good way to compare time decay a little bit. Here's the $24.50 strike price that expires today. Since the stock is approaching 24, everything that you see here in terms of the ask is really just intrinsic value. Very, very little in the way of time value. We can see that reflected in the $24 strike price. But if we go out 1 week, here's 24. All of a sudden, look at how those numbers change. Barry's in at 25 some time ago. So you're a little bit below your purchase price right now. Here's 2 weeks out at 24, 57 cents, 62 cents. 3 weeks, now you go to 74, 73, 80, 83. And the numbers are changing as we speak. 4 weeks, 94, 99. So these are really illustrative of the impact of time decay. Even on a weekly basis, you can see how that accelerates the closer to expiration that you get. So you're in at 25 on this, which means you'd have to sell quite a bit out of the money. But let's take a look here. I don't know. Again, depending on what you're looking for, what you're willing to do or not do, obviously. Assuming that gap call expires today at 27, which it should. Here's 25. The $25 strike price get almost 2% for 3 weeks. At 25, this could just be, if this is just another dip along an expected longer term upward trend, maybe that doesn't work out for you so well. Going to 25.50 is 32 cents. It's not quite your 1.5%, but 25.50 for a month out, you can get 44 cents. That's also interesting. 44 divided by 25, 1.7% for 1 month out. That builds in a little bit of capital gain, about 50 cents, not a ton, but that would also be pretty functional. Very nice. So Barry assigned at 25 back in April, brought in over $3 in covered call premiums when it's made sense, plus collected 3 dividends at 15 cents. So let's talk about that cumulative result. Thank you, Barry. I really appreciate those numbers. And I'm pulling up a document here just so that I can throw these out. Barry Gap stock buy. Was it $25? Covered call premiums, $3. Dividends, 3 times 15 cents equals 45 cents. So total income on this, $3.45. And then your net cost basis, just because if I do it in my head, be a little bit less precise. Here we go, $21.55. Not bad. Not bad for a stock that is still at 24, right? Again, talk about no stress that Jay had with LRCX, right? Barry, you got no stress with Gap, right? This is in a really, really good spot for you right now. And I love what you said, brought in over $3 in covered call premiums when it has made sense. You don't have to do this all the time. Some of the people that work with that we've worked with in the Rebel Income community, we've heard from, they'll actively sell covered calls below the strike price that they were assigned at, which is fine as long as you're going to be a lot more active about managing those covered calls. Because if the stock suddenly rebounds really quickly and moves above that strike price, you could get called out below the price you bought the stock at, right? But if you don't want to be that aggressive, that active about managing your trades, it also makes sense to just be patient. Those covered call opportunities will still happen. You may have several of them, you may not. It just kind of depends on the stock and what circumstances of the market give you. But Barry, this is another really, really good example of the benefit of just being patient and making trades when they make sense to you. This overall result isn't going to happen every time, just to be completely transparent. But when it does, this makes the stress of investing really, really manageable. Sorry, including the put sale premium brought in 368. So that was about another 23 cents. $368. Now I am going to need my calculator. Minus 23, so 21.32. Literally speaking, that is a fantastic job of not just generating useful practical income, but also just a great example of how income generation makes it easier to manage long-term stock positions and to allow you to take a more objective approach to the stocks that you are working with and think about them in less emotional terms. Emotion is the big enemy that we're all trying to manage and figure out what to do with. That's why the last couple of weeks, the articles I've posted on Thursday have dealt with fear and greed, because those are the things that are working against us the most. When you can do the kinds of things that Barry has demonstrated for us, and thank you for sharing that with us, Barry. when you can do these kinds of things, it makes it a lot easier to not pay attention to what fear and greed are trying to tempt you to do. So, really appreciate that. Can't say enough about how awesome that result is. Love it. Everybody, we're at time, and I do appreciate your participation and all the comments that you've had. Thank you, thank you, thank you. I hope you have a wonderful weekend. Um, we are just in the interest of full disclosure, coming up on the Christmas holiday. As I was looking at the calendar, Christmas Eve does fall on a Tuesday, and then obviously Christmas is the Wednesday after that. So we'll take a little bit of a break at that time, not in terms of live streams, but you will see me take a break from. I'm not going to post a trade on Christmas Eve. Sorry, I'm going to be trying to help my wife wrap up our Christmas arrangements. And then, of course, Christmas Day, there won't be any post. But other than that, you'll still see all of the content that I produce every single day. If you have any questions, go ahead and message me on Discord, or go ahead and email me at rebelincomesystem@gmail.com. Barry, I wrote calls ranging from 25.50 to 27, depending on the price of the time. Great result, no matter which way you slice it. So again, I appreciate it. Thanks, everybody. Talk to you again next time.